Hey, expert investors, Paul here. Today we're going to talk about stock market returns versus real estate in Canada. All right. So this is a very, very common conversation. Not so much a question, but a conversation I'm always having with new investors that I'm meeting on a weekly basis. Because when this question's posed, or when someone comes to me and says, I've been investing in the stock market, or I have a mutual funds, or I have a financial planner who manages my stock investments, there isn't a simple answer I can give. We have to do a comparative analysis of what's happening, what their results have been, versus what's possible with real estate from today forward. We can't go back in time, so we can only look at what we can do going forward, okay? So we're gonna look at Canadian real estate. So I put up some very basic stats here, and we're gonna talk about them. So the best metric I wanted to use and favorable for stocks is the S&P 500. So the Standard & Poor's 500. It's an index that measures the top 500 companies in the U.S. Okay. Now, as an individual investor, you cannot invest directly into the S&P 500. You have to invest or purchase shares or stocks in an ETF, an electronic traded fund that tracks the price of the S&P 500. But let's assume you bought it. Okay, let's be fair. I want to be super conservative here, so you don't think I'm fluffing one way or the other. So hit the historical return for the S&P 500 since its inception is about 7% a year. Not bad, okay? And in the last 10 years, this is 7% a year adjusted for inflation. So that's even more positive for the S&P, okay? In the last 10 years, 13.5% not adjusted for inflation, okay? These are these statistics I pulled. So that's fantastic, okay? So if you had an ETF tracking, you could have made 13.5% every year. But what's the real return? I mean, we all know that trying to pinpoint the exact correct time to buy and buy a stock or buy a fund or buy an ETF and then ride it out and hit that perfect return is next to impossible. But let's say you did it. I mean, remember, you're going to pay management fees. And on some of these ETFs, I mean, the management fees are pretty low. A lot of them under 1%, so that's fair. So just like when you're calculating your cash flow in real estate and you're going to make $1,000 a month, you have to factor in things like management, landscaping, maintenance costs that factor in and draw down your returns. And it's the same thing with a stock investment. You have to calculate the management returns because you are going to pay them in the fees. And calculating your entry point is probably the most challenging thing, because as humans, we're many times driven by emotion. And if you bought at the wrong time and sold at the wrong time, you might be negative return, even though the fund as a whole has done positively. Okay? So, but let's assume you nailed it perfectly and you're tracking returns similar to this, or even slightly less because you're paying a management fee. Okay, let's be super conservative. So, let's take another example of a house in Toronto. Purchased, the average price in Toronto in the year 2000, purchased $350,000. Fast forward 20 years later, and I'm using 2020 stats, not 2021. We'll skip the big returns we've had in 2021, to be fair, okay? Fast forward to 2020, same house, average price, $960,000. That's a 175% increase, but only a 5% annual return on appreciation. So, I mean, obviously you should have invested in an exchange traded fund tracking the price of the S&P 500, right? Well, what's the real return here? Now, we all know, especially if you're listening to my videos, that there's three types of returns you get in real estate. One, obviously the appreciation. You buy an asset for X price, over time it goes up to Y, and you get that equity appreciation, but there's also cash flow. So you want to rent this house out to a nice person, a nice couple, a nice family. They pay the rent. And you pay your expenses, your mortgage, your taxes, insurance, etc. And whatever's left over is your cash flow, right? So, and as every month that you able to pay your mortgage with that rent money, your mortgage, the principal value of your mortgage goes down each and every month. So you get a bit of a return every time you collect your rent simply by paying your mortgage, okay? Your mortgage goes down, and it's not you essentially paying it with money out of your own pocket. You're using the rent money to pay the mortgage. Therefore, in a sense, your tenants are paying down your mortgage for you. I know it's not exactly like that, but it's not your money and it's coming from your rental income. So it could be your property, your tenants, however you want to describe it, but it's not your money. So you get a return on that. But I'm not even calculating it here. I'm simply looking at the price difference in the stock market, because the stock market some of them give you dividends, some of them don't. But most of the time, if you're buying stocks, you're buying it for price X and you're trying to sell it for a price Y, hopefully a lot higher. Buy low, sell high. And in our formula for real estate, we're looking to do that also, of course. But while we own the property, we want to ensure that our rental income more than covers our expenses, and we generate cash flow because we get a return there. So what's the real return if we were to factor in cash flow and your mortgage getting paid down? Let's just say a lot more. But for argument's sake, let's be super conservative. Now, the one big thing we're missing here is who buys $350,000 houses in cash? I want to be somewhat realistic here. I shouldn't say no one, but I'd say 99.9 or 99.5% of people are not going to buy this house in cash and simply hold it for an investment. Why would you do that if you can get financing? So if you bought this house in the year 2000, you would have put a 20% down payment or less, but 20% down payment to purchase this property, and the bank would have given you an 80% mortgage. So instead of spending $350,000, you would have spent $70,000, 20% down. So when you're calculating your return over a period of time, we're not actually using the $350. We want to know what your return is on the actual cash you put out. So to be fair, $70,000 investment in the year 2000, that gets you a gain. You've gained from $350 to $960, a total of $610,000. That's a return of 770%, or 11% a year annualized. And again, remember, we haven't calculated your actual cash flow, and we haven't calculated your mortgage pay down. Okay, now for the skeptics out there, obviously over a period of 20 years, there's going to be maintenance and repairs and landscaping, and the roof's going to leak, and the furnace has to go, the AC you have to change, there's vacancy, all that kind of stuff. So again, for the conservatives out there, for the skeptics, let's say you were making $300 a month cash flow. Very conservative. Let's say you spent all of that cash flow, every dime of it, over a period of 20 years to maintain the property. The roof, the AC, the air conditioning, the furnace, the landscaping, covering vacancies in between tenants, repairs, upgrades, all of it. You spent it all. So technically your return on your cash flow is nil, zero, break even. But they paid down your mortgage. So on the April 15, 2020, you got a mortgage, you put down $70,000, your mortgage was $280,000. Now, I'm not going to do the calculation here because it's not appropriate for a short summary video like this to bring a point across, but your mortgage would have been $280,000. Now think, over a period of 20 years, what would the mortgage be? 20 years later in 2020? The mortgage would have obviously gone down, and none of that would have been your cost. So if the mortgage in 20 years got paid down from 280 to say 150, a little bit less than half, if you've got a 25-year mortgage, you would have paid down most of it, a lot more than that. But argument's sake, another, let's say it paid down to 150 grand. That means you made another 130 on top of this. So your return is even higher. Okay? So and a few other notes for you to consider. And I mean for this video to be really an eye-opener so you can do your own research here. Don't believe me, because I'm a salesman, I wear a salesman hat. So I don't want you to believe anything I tell you. I want you to do your own research, okay? So other advantages, taxes. So if you make this amount per year and then sell it 20 years later, you make, if I didn't put a number here, but if you made 500,000 a year over the period of you owning this stock, whatever the amount of money is, technically you're going to get taxed. And the capital gain tax in Canada is 50%, or close to it. Now, in real estate, although capital gain tax is the same, you have multiple ways to mitigate your tax burden where you don't have in the stock market. So because you absorb control, much more control over the investment, and you become, very careful, responsible for the investment in real estate, you get a higher return. It's more of a pain in the rear end, but you get a much higher return, and you have much more tax write-offs because of that responsibility. So you can mitigate the tax burden, okay? Cash flow, I mean, we talked about it a little bit here, but if you're a little bit more sophisticated in how you buy, and instead of buying a single family home, let's say you bought a duplex or a triplex or a fourplex or say a student rental or any kind of multifamily type property, if you're adding units, if you're adding value, you can make significant returns on cash flow and build yourself a portfolio that provides you like a retirement type of income. So you can retire from your job early, you can live your lifestyle the way you want to live. So that's another conversation altogether. So real estate has the power to do that. You can do that in stocks too. Definitely some provide dividends, but the ability to create income and manipulate that income is much more powerful in real estate. Okay, and we talked about the pay down. So your rental income and your tenants paying down your mortgage for you, and you creating long-term equity. Okay, and control. So because you're able to control the asset, you get a significantly higher return. Okay, and that's the power. When you invest in stocks, you pay a management fee, and you give up control to a management company who takes a fee for it. So when the stock market goes up, they're the heroes. And when the stock market goes down, guess what? Those management people still get paid. And you're the one who ends up suffering those losses. Okay, it's not like they suffer with you. So, management is also an important subject in real estate. You can take your property, your rental property that creates some cash flow, and hand over the day-to-day management to a property manager. And that's going to cost you some money. But what I'm here to tell you is property management is going to cost you something regardless. Okay, it's either going to cost you dollars for paying a property manager out of your income, or it's going to cost you pain in your rear end and your time because you're going to have to do it yourself. So it's unavoidable. It's just simply a decision of whether you pay someone else to do it or you take on the responsibility yourself. Okay, and volatility. This is a huge one. So the stock market in general, highly volatile. If you look at you got to research it yourself, but if you look at the return graph for the S&P, it's like this, up and down and up and down and up and down. And for traders and people who are sophisticated at going in and out of the stock market, that's a good thing. Traders like volatility. But for long-term investors who want to focus on their career, focus on their business, focus on their job, focus on enjoying their family and their cottage and all the good things that we want in life, we don't want to look at our investments every 5 minutes every day. We want long-term returns, and volatility is not our friend. And consistent returns is a staple, an absolute staple of real estate. So to me, it's an inherent advantage that you get by doing this. So obviously, this is a bit one-sided. I prefer real estate, and I'm doing real estate myself. I coach other real estate investors. I help real estate investors build portfolios that have a positive impact on their lifestyle. And I'm here to explain some of these common differences to you so you understand the real data, okay? Not the hype we read on Google or what your friend did or what your neighbor's doing, okay? So if you want to know more about how this relates to you, hey, real estate might not be right for you. And in fact, 50% of the people I talk to don't end up working with me because it's not right for them, and that's okay. I can't work with everyone, and real estate's not right for everyone. And if it's not right for you, I'd rather shake hands with you and get to know you and refer you somewhere else or suggest something else to you that's going to work for you. But for those of you, some of you are missing out on something really positive here that's going to have a true positive impact on your lifestyle. It's not so much about ROI and how much money we make, but if we can use real estate to help us buy that dream cottage, help you drive that big red Ferrari that you want, help you purchase that red brick dream home that you want. If it's putting your kids through university, if it's paying off your mortgage, if it's paying off your parents' mortgage. I'm just using examples that investors have told me. When you come to me and you invest in real estate with a personal goal in mind, our sophistication, our advisory, and your work ties in perfectly with a real personal goal that's close to your heart. And if you can do that, you will accomplish great things. So I've left a link down here in the bottom of the video in the description. If you want to get a hold of me, talk to me in a little bit more detail about how real estate can work for you here in Canada, and especially in Southern Ontario where I am, book a call with me, sign up to my email list, and we'll be in touch. Talk soon.